All right, welcome everyone to another deep dive. Today we're tackling a true classic in the investment world.
That's right, we're diving deep into One Up on Wall Street by Peter Lynch.
You know this one well, right?
Oh, absolutely. It's a must-read for anyone even remotely interested in investing.
Our mission today, or maybe our game plan, is to break down Lynch's key concepts, those real-world examples he's so good at using, and of course all those practical tips he peppers throughout the book.
Yeah, it's all about making this deep dive as useful as possible for everyone tuning in.
Exactly. We want everyone listening to walk away with a solid grasp of Lynch's core approach to investing. No fancy jargon, just that fundamental wisdom he's known for.
And by the end, hopefully everyone's got a few aha moments and a renewed sense of, what to look for when they're thinking about investing.
Okay, perfect. So Lynch kicks things off with an introduction titled Old Hat Fundamentals. Right away, he takes us back to the dot-com boom, around the year 2000. And he's pretty skeptical, right, of all that hype surrounding internet companies.
Oh, yeah. He was definitely raising an eyebrow at all those sky-high valuations. He saw a lot of companies being valued based on pure potential, what they might achieve in the future, rather than their actual solid earnings.
Which, let's be honest, is a trap a lot of people still fall into today.
For sure. And he specifically warns about jumping on the bandwagon after a stock has already shot up in price. It's that classic fear of missing out, but he reminds us how hard it is to time it perfectly and how those initial huge gains might never, ever come back.
He uses this really clever analogy comparing Microsoft and Apple. Microsoft was the gas, he said, powering all these different computers. Apple was more focused on the boxes themselves.
It's a great way to show the power of a fundamental business model. Microsoft was providing something essential, that operating system.
Right. And Apple, even though they were making great products, faced a lot more competition. It's like he's saying, focus on the companies that provide the crucial infrastructure.
Absolutely. It's about looking for those companies that are integral to a larger ecosystem. Their success isn't just about one product. It's tied to the overall health of the industry they're in.
Now, he also talks about General Electric. He actually recommended it earlier in his career, and it went on to become a 10-bagger.
That's a tenfold increase, for those who don't know.
Right, a tenfold increase. But he admits he was initially hesitant because GE was already a massive company.
And it's interesting because it shows even seasoned investors like Lynch can have these biases. You think, oh, it's too big to grow that much more.
Exactly. But then someone like Jack Welch comes in, shakes things up, and bam, massive growth.
Yeah.
It really highlights the importance of keeping up with a company's story, seeing how things evolve.
Absolutely. Dynamic leadership can totally change the game, even for giant corporations.
He doesn't shy away from tougher topics either.
Ah.
He talks about the Nifty 50 era, reminds us that market corrections, those dips, and even full-blown bear markets are just part of the game.
Which is something a lot of new investors especially might not realize.
For sure. And he doubles down on that classic advice. Don't put money in the stock market that you need in the next, say, 12 months. You don't want to be forced to sell at a loss just because the market takes a temporary hit.
It's all about having that long-term perspective, riding out those inevitable waves. He even backs it up with hard numbers, showing how staying invested over time beats trying to time the market.
I love that quote he uses. The bearish argument always sounds more intelligent. It's so true. There's always someone predicting doom and gloom, and they often sound so convincing.
Right, because fear sells.
Yeah.
But Lynch is reminding us not to let that fear derail our long-term strategy. Do your research, look at the fundamentals, don't just react to every scary headline.
And to prove his point, he shows this table of the top 100 winning stocks from the 1990s. And guess what? A lot of them are household names. Dell, Microsoft, Intel.
Names everyone recognizes, which is his point exactly. He's saying you don't need to be a Wall Street whiz to find good investments.
Right. Just understand the products. See what's gaining traction, what people are actually using. He even shares this anecdote about being in Ireland during that massive market crash in 1987. Everyone back home is freaking out, and he's on the phone looking for buying opportunities.
Talk about keeping a cool head. That's the investor mindset we all need to learn from. When everyone else is panicking, that's when you find the real opportunities, if you can stay calm and focused on the long term.
Absolutely. And he wraps up the introduction with these amazing examples of long-term growth, like a small investment in the Gap back in '76, turning into a huge sum by '87. Same story with La Quinta. These are real, tangible examples of how powerful, well-chosen stocks can be over time.
It's all about picking the right companies and having the patience to let them grow. That's the core message.
Okay, so we've got this foundation of long-term thinking, ignoring the noise, focusing on solid businesses. Now we get into part one of the book, preparing to invest. This whole section is all about getting yourself ready mentally and financially before you even think about buying a single share.
It's like laying the groundwork, making sure you're approaching investing with the right mindset and a solid plan.
Right. He wants you to ask yourself some tough questions, like how much do you trust the stock market in the first place?
And what are your actual goals for investing? What are you hoping to achieve? Are you saving for retirement decades down the road, or do you have shorter-term needs?
And maybe most importantly, how do you think you'll react when the market inevitably takes a dip? Because those dips are going to happen no matter how good you are at picking stocks.
It's about being honest with yourself, knowing your own risk tolerance. And he makes this really crucial point. Your success as an investor isn't just about the market itself or even the companies you choose.
Right, it's much more personal than that.
It's about you, your financial situation, how you handle your emotions, those personal qualities you bring to the table. Those are the real deciding factors in the long run.
Okay, that leads us to chapter one, the amateur investor, his edge. And right away, you can sense Lynch is a champion for the individual investor.
He's all about empowering people to take control of their own financial futures.
And he starts by sharing his own experience, his first big win with Flying Tiger. It became his first five-bagger.
Meaning it increased fivefold in value. Not bad.
And what's interesting is it wasn't based on some complicated formula or insider information. He just saw a trend, understood a business, and made a smart bet.
That's what's so encouraging about that story. It shows that anyone with a little bit of knowledge and common sense can spot these opportunities.
Exactly. And he talks about getting a summer job at Fidelity Investments. How eye-opening that was.
It's like getting a peek behind the curtain of the entire financial industry, seeing how things work, how decisions are made, the scale of it all.
And he presents this really compelling data showing how stocks over the long haul have outperformed bonds and even those safe treasury bills by a huge margin, like significantly better returns.
And his explanation makes total sense. When you invest in stocks, you're owning a piece of a company that's hopefully growing and expanding. With bonds, you're basically just lending money, and your potential upside is much more limited.
I love the analogy he uses. The stock market's like a seven-card stud poker game. You see some cards, you don't see others. You have to make informed decisions based on the information you have.
It's a brilliant analogy, right? It captures the element of risk, the incomplete information, and the need to make smart bets based on what you can see and understand.
And then he takes it even further, saying owning a bunch of different stocks is like playing a 70-card hand, or even multiple hands at once.
It emphasizes the importance of diversification, spreading your bets across different companies to manage risk.
Exactly. So we've learned about the amateur's edge, the power of observing the world around you, finding those hidden gems before everyone else does. Now we move on to a chapter that's all about self-reflection. Chapter 2, Passing the Mirror Test.
This one's all about taking a hard look at yourself, your financial situation, and your personality before diving into the market.
And he poses three really essential questions. The first one is, do I own a house? And you might think, what does it have to do with investing?
But his reasoning is actually quite insightful. Owning a house, he argues, can provide a certain level of financial stability and emotional security. You're less likely to make rash decisions based on short-term market swings if you've got that solid foundation.
Right, you're not constantly checking the value of your house the way you might obsess over stock prices. It helps you stay more grounded, more focused on the long term.
Absolutely. And that emotional stability is so crucial for making good investment decisions.
The second question is much more direct. Do I need the money? And his advice is crystal clear. Only invest what you can truly afford to lose without it impacting your life in a significant way.
It's a fundamental principle of risk management. Don't put money in the market that you need for rent, bills, or other essentials. You don't want to be forced to sell at a loss because you suddenly need that cash.
Right. Only play with money you can afford to walk away from. And his third question is all about personality. Do I have the personal qualities for success in stocks? And he lays out this whole list of traits.
It's quite the checklist. He talks about patience, the ability to think for yourself, common sense, a tolerance for risk, open-mindedness, detachment, persistence, humility.
It's like he's painting a portrait of the ideal investor. And what's interesting is he even mentions the ideal IQ range, saying that sometimes being too smart can actually work against you.
He's suggesting that overthinking and overanalyzing can lead to paralysis by analysis, which can be just as harmful as making impulsive decisions.
It's about finding that balance between being informed and being decisive.
Exactly. So you've looked in the mirror, you've asked yourself the tough questions, you've got your financial house in order, and you're feeling mentally prepared. Now it's time to tackle the big question. How do you actually go about picking winning stocks? And that's where part 2 of the book comes in, picking winners.
And this is the meat of the book, right? This is where he reveals his strategies, his methods, his secrets for finding those hidden gems.
Exactly. He gives you a whole toolkit for analyzing companies, understanding their stories, and making informed decisions. He starts by talking about exploiting your amateur edge, the unique insights you have as a consumer.
Which we touched on earlier, right? Your everyday experiences can actually give you an advantage over those Wall Street pros who are often stuck in their ivory towers.
Absolutely. He talks about observing trends, noticing new products, paying attention to what people are actually buying and talking about.
And he gives examples like the Gap, how it exploded in popularity, or La Quinta, filling a specific need in the motel market. It's about being aware, being curious, and connecting the dots between what you see in the real world and the companies behind those products and services.
And he also uses this fascinating example of the mutual fund industry. He points out that people working in related businesses, like the printers who made prospectuses or the salespeople who marketed funds, they saw firsthand how fast the industry was growing.
And that gave them an early clue, right? They could see the potential and make smart investments.
Exactly. It's about being in the right place at the right time and having the awareness to see the bigger picture.
All right, so we've got this foundation of leveraging our everyday experiences. Now we get into chapter 13, the perfect stock, what a deal. And this is where things get really interesting. Lynch lays out all these, let's call them quirky characteristics to look for in a potentially good investment.
And some of them might seem a little counterintuitive at first. He actually starts by saying, it sounds dull or ridiculous.
That's not usually the advice you get, right?
But his reasoning is that a boring name can actually be a good sign. It keeps those momentum chasers away, the people who are just looking for the next hot stock.
And he gives some great examples. Pep Boys Manny, Mo and Jack, Bob Evans Farms, Consolidated Rock. These aren't exactly the sexiest names in the market, but they often make for solid investments.
It's about looking beyond the hype and finding those under-the-radar companies that are quietly generating strong earnings.
Right. And his second characteristic is it does something dull. Again, not the most exciting advice, but he makes a good point. Companies in unexciting industries can often fly under the radar and offer great value.
Exactly. He gives examples like Crown Cork and Seal, which makes cans and bottle caps, or Seven Oaks International, involved in coupon processing. Not exactly glamorous, but essential businesses that people often overlook.
It's about finding those steady, reliable earners that are providing essential products or services. And then he talks about spin-offs. These are companies that have been separated from a larger parent company.
And they often present really good opportunities. He talks about the baby bells that came out of the breakup of AT&T, many of which went on to do incredibly well.
Right. These spin-offs often have strong balance sheets, motivated management teams, and they're often undervalued because the market hasn't fully caught on yet.
Exactly. It's a chance to get in on the ground floor of a newly independent company that has the potential to really take off.
Another characteristic he looks for is institutions don't own it, and analysts don't follow it. And that sounds almost backwards, right? You'd think you want the big players to be interested.
But again, Lynch is going against the grain here. He's saying that a lack of Wall Street attention can actually be a good sign. It means the company is under the radar, potentially undervalued, and you have a chance to get in before the herd arrives.
He even mentions rumors abound, but with the caveat that there's something fundamental the company has going for it. He uses the example of aggregate rocks, sand, gravel, as a surprisingly profitable business because of the high transportation costs, creating local monopolies.
It's those kind of niche businesses, the ones that are essential but often overlooked, that can provide really solid returns.
And that leads to his next characteristic. It's a niche. He talks about Warren Buffett's early investments in newspapers and TV stations that dominated their local markets. He also mentions his own investment in affiliated publications, which owned the Boston Globe.
It's about finding those companies that have carved out a strong position in a specific market where they have a real competitive advantage.
Right. And another characteristic, the users have to keep buying it. He uses Wrigley's gum as an example. It's a simple product, but people buy it over and over again no matter what the economy is doing.
It's about finding those products that are essential, or at least habitual,
Yeah.
where there's a consistent demand.
And then there's insiders are buying. He makes a good point here. If the people who run the company are buying stock, that's a pretty good sign. They know the business better than anyone,
Hmm.
and they're putting their money where their mouth is.
It's a strong vote of confidence from those who know the company best.
And finally, the company is buying back shares. This could be a good sign because it means the company believes its stock is undervalued, and it also has the effect of increasing earnings per share for the remaining shareholders.
It's a way for companies to return value to their investors and signal their confidence in their own future.
So we've got this whole checklist of often overlooked traits, things that might not scream exciting investment, but that often point to solid, undervalued companies. Now, in Chapter 14, Lynch goes deeper with some specific case studies. He profiles 3 stalwarts: automatic data processing, or ADP, Procter & Gamble, and Paychex.
These are all companies that have demonstrated consistent, reliable growth over the long term, even through different economic cycles. They're well established, they have strong brands, and they provide essential products or services.
ADP with its payroll processing, P&G with its huge portfolio of consumer goods, Paychex serving small businesses. They're not flashy, but they're steady earners, and that's what Lynch loves.
It's all about understanding how these companies have achieved and maintained that consistent growth, what their strengths are, what makes them resilient.
Okay, so we've learned about what to look for. Now, just as important is knowing what to avoid, and that's what Chapter 15 is all about, when to avoid.
This is all about risk management, recognizing those red flags, those situations where you might want to steer clear.
He starts with hot stocks in hot industries. And we've all seen this happen, right? A new industry emerges, there's a ton of hype, everyone piles in, and then
the bubble bursts.
Exactly. He uses examples like mobile homes, digital watches, HMOs. These were all hot sectors at one point, but the hype often outpaced the reality.
It's about being cautious, doing your research, and not getting swept up in the frenzy. He also mentions the carpet industry as a cautionary tale. A lot of innovation, but fierce competition and falling prices made it a tough place to make money.
Right. So be wary of those hot sectors, even if everyone seems to be making money. Another thing to avoid, the next something. Companies that are touted as the next Amazon or the next Tesla.
There's always this temptation to find the next big thing, to get in early on the next Google or Apple.
But the reality is most of these companies failed to live up to the hype. He gives examples like Child World, which was supposed to be the next Toys R Us, or Warehouse Club, which was supposed to be the next Price Club. Both stumbled.
It's a good reminder to be realistic, to focus on the fundamentals of a business, and not get blinded by comparisons to past successes.
Another thing to watch out for, diworseifications. This is when a company, often a successful one, starts making acquisitions outside of its core expertise.
It's that classic case of empire building where companies try to grow too quickly or into areas they don't understand.
And it often leads to trouble. He notes that a lot of companies go through these cycles of diworsifying and then restructuring to undo the damage. It's best to be wary when a company starts making those big, splashy acquisitions.
Especially if those acquisitions seem expensive or unrelated to the company's core business.
And finally, he warns against whisper stocks. These are those companies with incredible but often unsubstantiated stories, miracle cures, revolutionary technologies, things that sound too good to be true.
And often, they are too good to be true. He gives a whole list of examples, companies that promised the world but ultimately crashed and burned.
So the takeaway here is clear. Stick to companies you understand, whose businesses you can analyze, whose stories make sense.
Absolutely. Don't get caught up in the hype, the rumors, the promises that are too good to be true.
All right, so we've covered what to look for, what to avoid. Now we get to the heart of what drives stock prices. Chapter 16, Earnings, Earnings, Earnings.
This is Fundamental Investing 101.
Right, and Lynch makes it clear. Earnings are the lifeblood of a company, and ultimately they determine the long-term value of its stock. He even provides real-world examples to prove his point.
Like Ford Motor Company, how its stock price tracked very closely with its earnings over time. And Avon, how its stock soared when earnings were good and then plummeted when earnings declined.
It's a powerful illustration of how crucial earnings are to the health of a company and therefore to the value of its stock.
He also talks about the danger of getting too fixated on a high price-to-earnings ratio, or PE.
It's a popular metric, but he points out that even great companies can become overvalued if their PE gets too high relative to their actual earnings growth.
He uses the example of McDonald's in the early 70s, how it was trading at a PE of 50, a huge number. And even though McDonald's was, and still is, a fantastic company, that valuation proved unsustainable.
Right. And he makes a similar point about Polaroid's SX7D camera. It was a great product, innovative, but the expectations were so high, baked into that high PE, that even success wasn't enough to justify the price.
It's a great reminder that valuation matters, even for great companies. And he briefly touches on the overall PE of the market as a whole, suggesting it can be an indicator of market sentiment, whether things are generally overvalued or undervalued.
But he's careful to say that it shouldn't be your only focus. You need to look at individual companies, their earnings, their growth prospects.
Exactly. Don't just blindly follow the market or chase those high PE ratios. Focus on the fundamentals of the businesses you're investing in.
So we've got earnings as the cornerstone. Now, Chapter 17 introduces a concept that's really at the heart of Lynch's approach, the story.
This is about going beyond numbers and understanding the narrative, the underlying factors that are driving a company's success, its potential for growth, its competitive advantages.
It's about being able to explain, in simple terms, what a company does, why it's good at what it does, and why it's positioned for future success. He uses La Quinta as an example, how it carved out this niche in the motel market, targeting business travelers with a specific value proposition.
Offering a good level of comfort and amenities at a lower price point than the big chains, and in locations that were convenient for their target market.
Understanding that story, how La Quinta strategically positioned itself, is key to understanding its growth and potential. So it's not just about the numbers, it's about understanding the why behind the numbers.
Absolutely, and it's about making sure that story stays intact over time. Are the factors that made the company successful still in place? Is the management team executing on its plans?
Right. You need to continuously monitor that story, make sure it's still holding up, that the company is delivering on its promises.
Now, once you've got a good handle on a company's story, it's time to dig deeper, to gather the data, to verify the narrative. And that's where Chapter 18 comes in, getting the facts.
And Lynch is very clear. There's a ton of information out there readily available that you can use to research companies.
We're talking about company prospectuses, annual reports, industry publications, even company newsletters. He also stresses the importance of doing your own research, not just relying on what your broker tells you.
He even gives you a list of questions to ask your broker. Things like, can I see the analyst reports? What's the stock's price history compared to its earnings? What about its dividend history?
And what about institutional ownership? Is Wall Street paying attention to this company? And he talks about reaching out to the company directly, talking to their investor relations department.
It's about being proactive, asking questions, getting a more complete picture of the business. And he gives specific examples of the kind of information you might look for, like sales figures for a key drug or updates on production capacity for a manufacturer.
It's all about gathering the data that supports, or maybe challenges, the story you've developed.
Right. And then comes a chapter that I think is often overlooked. Chapter 19, visiting the company.
This one's all about getting out of the spreadsheets and into the real world, getting a first-hand look at the business you're considering investing in.
And Lynch believes there's real value in that, and seeing the company's headquarters, maybe their factories or stores, getting a feel for the culture.
He shares some great anecdotes, like how he was impressed by Taco Bell's frugal headquarters, how he noticed a lack of analyst visits at a bank he later invested in.
And he emphasizes the value of talking to employees, just getting a sense of their morale, their enthusiasm for the company.
It's those qualitative insights, those things you can't always capture in a financial report that can really add to your understanding of a business.
And he shares positive experiences he had, like seeing the continued popularity of Apple products or witnessing Lee Iacocca's bullishness about Chrysler's turnaround. It's about confirming your thesis or maybe spotting some red flags that you wouldn't see just by looking at the numbers.
It's a great reminder that investing isn't just a numbers game. It's about understanding real businesses, run by real people, selling real products or services.
Okay, so we've gathered the qualitative insights. Now it's back to the numbers. Chapter 20, the numbers. And Lynch focuses on a few key metrics that he thinks are particularly important.
He starts with the cash position. How much cash does a company have on hand? Because cash is king, as they say. It gives a company flexibility, the ability to make acquisitions, buy back stock, weather tough times.
Right. And he gives examples like Ford in the 80s, how its strong cash position helped it through a difficult period. But he's careful to point out that it's not just the total amount of cash that matters, it's the cash per share.
Exactly. You need to look at the cash relative to the number of shares outstanding. And then he talks about book value. This is the company's assets minus its liabilities. But he cautions that book value can be misleading. It doesn't always reflect the true worth of a business.
Like he mentions Penn Central, which had a seemingly high book value right before it went bankrupt. Or Warren Buffett's experience with Berkshire Hathaway's textile mills, where the book value didn't really translate into real-world value.
It's a good reminder to be skeptical of book value, to look deeper and consider factors like debt and the actual market value of a company's assets.
And finally, he talks about growth rate, specifically the growth rate of a company's earnings. And he's very clear. This is the most important metric for long-term stock performance.
He uses Philip Morris as an example, how it managed to grow its earnings even as cigarette consumption was declining. They did it through cost cutting and price increases.
It's a great example of how companies can find ways to grow their profits even in challenging environments. And he warns against those companies that promise incredibly high growth rates, especially if those promises are based on overly ambitious diversification plans.
It's about being realistic, looking for sustainable growth, and not getting caught up in hype or unrealistic projections.
Okay, we've got the numbers down. Now we shift our focus to the long game. Part 3, long-term view. And this is where Lynch really emphasizes the importance of patience and discipline in the stock market.
He suggests aiming for a 12–15% annual return to make stock picking worthwhile. And he stresses the benefits of holding on to stocks for the long term rather than trying to time the market or jump in and out of positions.
And that makes sense, right? The more you trade, the more you pay in commissions and fees, which eats into your returns. He also talks about portfolio size and diversification.
He acknowledges the debate between those who favor concentrated portfolios holding a smaller number of stocks they know really well and those who prefer more diversification.
And his advice is to focus on quality over quantity. It's better to own a handful of companies that you truly understand and believe in than to spread yourself thin across dozens of stocks you haven't thoroughly researched.
It's about conviction and understanding. And that leads us to Chapter 22, Portfolio Strategy.
This is where he gives practical advice on how to manage your holdings, how to think about your portfolio as a whole.
And his first piece of advice is simple but powerful. Know what you own and know why you own it. You should be able to explain in clear terms why you've chosen each stock in your portfolio, what your investment thesis is.
And he stresses the importance of staying informed, revisiting your thesis whenever the company's situation or the market environment changes significantly.
It's about being an active manager of your portfolio, not just a passive holder of stocks. And then he gives some very practical advice on what to do with your winners and losers.
He says, if favorable cards turn up, add to your bet. Meaning if a stock is doing well and the story is still intact, it might be a good idea to buy more.
And conversely, if a stock is doing poorly and the story has deteriorated, it might be time to cut your losses. He uses a great analogy. You won't improve results by pulling out the flowers and watering the weeds.
It's tough advice, but it's essential for long-term success. Don't be afraid to let go of those losing investments, and don't be shy about adding to your winners. And finally, in this chapter, he offers some very level-headed advice. He says, if you can't beat the market, buy a mutual fund.
It's a recognition that stock picking isn't for everyone. If you don't have the time, the inclination, or the temperament, there are other options.
And he reminds us that there's always something to worry about in the market. So it's important to keep a balanced perspective and not get too caught up in the day-to-day noise.
It's about focusing on the long term, on the fundamentals, and on those companies that are quietly building value over time.
Okay, we've learned how to build a portfolio. Now comes the big question: when to sell? Chapter 23, when to sell. And this can be the toughest decision for many investors.
It's often harder to let go of a stock than it is to buy it in the first place.
But knowing when to sell is just as important as knowing when to buy. And Lynch breaks it down by category, giving specific advice for each type of stock. For stalwarts, he says, to look for a few things. A big run-up in the stock price, especially if the PE ratio is getting too high relative to the company's growth rate, a deterioration in the company's fundamentals, maybe new products are failing, growth is slowing, costs are rising, or simply the emergence of better investment opportunities elsewhere.
It's about recognizing when a company's best days might be behind it, or when there are simply better places to put your money.
For fast growers, he emphasizes monitoring earnings growth very closely. Look for signs that growth is slowing, that the company is making questionable acquisitions, or that the PE ratio is getting out of hand.
It's about recognizing when that high-growth story might be coming to an end.
For turnarounds, He suggests the best time to sell is often after the turnaround has been successful, when the company has essentially been reclassified as a stalwart or maybe even a slow grower.
It's about taking your profits once the recovery is played out.
And for asset plays, he advises patience. Wait for the market to recognize the value of the underlying assets, which often happens through a buyout or a spin-off.
It's about letting that value unlock itself, giving the market time to catch on.
So we've got a framework for selling, for recognizing those signals that it might be time to move on. Now, Chapter 24 is a fun one. 12 silliest and most dangerous things people say about stock prices.
This is Lynch at his best, debunking those common myths, those investing cliches that can lead people astray.
And some of them we've all heard, right? Like, it's gone this high already, how can it go higher? Or, it's only $3 a share, what can I lose?
These are those dangerous oversimplifications that can lead to bad decisions.
Exactly. He uses real examples to show how stocks can continue to climb even after they've gone up significantly. And he reminds us that a low stock price doesn't mean you can't lose a lot of money. It's all about the percentage change, not the absolute price.
And he tackles those other common sayings like, eventually they always come back, which just isn't true. Or